Well, for more analysis on what these latest employment figures mean, let's bring in Earl Davis. He is the head of fixed income and money markets at BMO Global Asset Management, joining us tonight from Toronto. So unemployment has dipped to 5.7% for the first time since December 2022. Are you surprised by that number?
Yeah, I was surprised by the number, and the reason why I was surprised is the expectation was it for to rise to 5.9 because of the amount of immigration and working age immigrants coming into Canada. You know, they said there was 120,000 came in January. I would suspect the number is similar for December. And because of that, that means to have a dip in the employment number, you have to have an increase in the job openings and the opportunities out there. So that was surprising given the economy we're in, but it's a positive surprise.
Okay, so Canada's job numbers look good this January with 37,000 new jobs, but we're seeing more part-time work as opposed to full-time. So is it normal for part-time work to be such a significant driver of employment?
Well, I always like to start from the base. More jobs is a good thing. It could always be better. And in this case, full-time jobs are better than part-time, but it's good. Is it normal? What I think it's reflective of, I think it's reflective of uncertainty around the economy. So if you're a business owner and you're looking to hire people and you're having GDP like we had last year, you know, hovering around zero in real terms in regards to growth, you're going to say, you know what? I'm going to hire someone part-time for now. Business is good. People are coming in, they're shopping, they're doing things, but I don't have the confidence to hire them full-time. I'll hire them part-time. The good thing about that is that if the economy continues to improve, as we're seeing, it's resilient, you know what, those part-time jobs become full-time. So, I'd summarize by saying it could always be better. Full-time's better than part-time, but it's good. It's a good start.
You know, we also saw the average hourly wage rise by 5.3% from last year. How effective will this increase be for everyday Canadians trying to deal with the cost of living?
Yeah, you know what? For everyday Canadians, it's actually a very good thing. And the reason why it's a very good thing is if your wages are increasing at 5.3% and inflation's 4%, it actually means that you're earning more than you're spending year over year. So that's a good thing from the real economy. I'm not sure the Bank of Canada would say the same thing.
Right. So, you know, this does sound great for workers, but what could this mean for the central bank when it comes time to decide on interest rates?
Well, I think it actually delays the easing of interest rates. It maintains interest rates at these levels. And the reason is the Bank of Canada thinks wages should increase. They like wage increases, without a doubt. But they think that range should be 2 to 3%. You know, when it's 5% and above, they're not happy with that. And the reason why they're not happy is if employers are paying employees 5% more, how do they get the money? They have to increase prices.
Right.
That's what you call a wage price spiral. And that's what they're worried about as long as wage increases are above 5%, even 4%. I think we have to go down to the 3% level for them to feel a bit more comfortable with easing rates.
Okay, I want to talk about the bigger picture here before I let you go. You know, these job numbers and the economic trends that we're seeing, I wonder what your predictions are for where the economy is headed in the next few months.
Well, it's interesting, you know, so in our role as asset managers, we invest money into fixed income, so we have to have our own outlook on the economy. And our theme for 2024 at the start of the year was constructive. These numbers confirm that. And we thought there could be an upside surprise to growth, which we are seeing actually right now. So we're optimistic for the economy for 2024. We think there's a fair chance that this sort of trend could continue in regards to maintaining employment at these levels. We don't necessarily see it going lower, like a 5.6 or 5.5, but maintaining it below 6 would be excellent. And we think there's a very good chance for upside surprise to GDP, which we're kind of seeing now. And the main reason for that is that the U.S. is just doing so well. And we're the U.S.'s largest trade partner. So if the U.S. does well, we do have knock-on effects here, and it's usually delayed. And we see that as being a 2024 benefit to Canada.
Okay, that's a bit of good news. Some optimism there. Okay, Earl Davis, the head of fixed income and money markets at BMO Global Asset Management in Toronto tonight.